As the first signs of an economic tempest move through the United States, an alarming increase in bank failures, a surge in unemployment claims, and a troubling decline in retail sales, we find ourselves perched on the edge of a deep recession. Staring into this uncertain abyss, the self-designated guardians of our financial destiny, the Federal Reserve and the U.S. government, are confronted with a monumental task. When the recession bells toll, how will they respond? Will the Federal Reserve and the Biden administration again disrupt the market's natural rhythms through rapid interest rate cuts, quantitative easing, QE, and excessive government spending? These interventionist measures, though designed to cushion economic downturns, distort market signals, leading to resource misallocation and the perpetuation of unsustainable structures. This approach hinders the market's self-corrective mechanisms, preventing a return to natural equilibrium. Permitting recessions to run their course enables an organic recovery. The non-interventionist approach, acknowledging short-term pain as a necessary component of long-term economic health, respects the market's self-correcting ability. It understands that the short-term pain of businesses, firms, and banks facing failure is a necessary component of long-term economic health and sustainability. In our quest for economic stability, we must turn our gaze to the inherent self-corrective mechanisms at the heart of the market. The annals of economic history are filled with instances where allowing these natural healing processes to unfold has catalyzed a return to prosperity, such as the recessions of 1819 and 1919 to 1921. The non-interventionist approach is a nuanced, constrained approach, one that demands patience and faith in the market's innate capacity to rebalance and recover. The path from a recession to a strong recovery passes through deflation of artificially inflated asset prices and liquidation of bad investments, which free up capital to be utilized in profitable sectors, starting the recovery. This idea is not without its critics, however. Keynesian and monetarist economists, who push a policy of extended QE, increased spending, and reduced interest rates, often argue that liquidation could exacerbate a recession by further reducing demand and creating unemployment. According to John Maynard Keynes in his 1936, The General Theory of Employment, Interest, and Money, the remedy for the boom is not a higher rate of interest but a lower rate of interest. His theory suggests that stimulating demand through lower interest rates and government spending would allow for a more gradual correction of malinvestments. Monetarists, such as Milton Friedman, also argue against liquidation. In his 1962, Capitalism and Freedom, Friedman states, "We believe that the Federal Reserve System should aim to mitigate, and, ideally, to prevent, severe changes in the total amount of money." This perspective suggests that maintaining stability in the money supply can prevent severe recessions and is a better cure for them than the potentially destructive liquidation process. These measures, however, risk prolonging the adjustment process and creating greater economic instability down the line. The recessions of 1819 and 1919 to 1921 serve as historical examples of the consequences of different approaches. The 1919 to 1921 recession, also known as the Depression of 1920-1921, was a significant period in the history of the United States economy. It is of greater significance because it has been completely ignored by most of the academic community, as it doesn't fit the Keynesian narrative of stickiness in prices, as James Grant's seminal work, The Forgotten Depression, 1921, The Crash That Cured Itself, demonstrates. Liquidation refers to businesses closing operations, selling assets, and using the proceeds to pay off debts. When a business cannot meet its financial obligations or is insolvent, liquidation becomes inevitable. During the 1919 to 1921 recession, the high rate of business liquidations contributed to the severity and length of the economic downturn. Grant especially scrutinizes the role of the Federal Reserve's monetary policy. The Federal Reserve, established in 1913, was relatively new during the 1919 to 1921 recession. Grant argues that the Fed's tight monetary policy of high interest rates and contraction of the money supply contributed significantly to the severity of the recession and the high rate of business liquidations. The Federal Reserve raised interest rates in late 1919 to combat the inflationary pressures that had built up during and after World War I. As we stand on the precipice of another potential recession, the debate over intervention versus non-intervention continues. The question remains, how will the guardians of our financial destiny navigate these troubled waters? Only time will reveal the path they choose and the consequences that follow. For now, we must remember the lessons of history, consider the long-term health of our economy, and trust in the resilience and corrective power of the market. Subscribe Libertarian Facts.